Ladies and gentlemen, welcome to the Business Brew. I'm your host, Bill Brewster, back after a slight break in July, and thrilled to be back. Excited to present this episode. James Davolos of Horizon Kinetics stops by to discuss the water disposal and servicing industry that is tangential to the oil and gas industry. I find it to be a very interesting idea, and I hope you all find it to be equally as interesting. Please remember that none of this is financial advice. All of the information contained in this program is for entertainment purposes only. Consult your financial advisor before making investment decisions and do your own due diligence. Additionally, Horizon Kinetics and its affiliates may own positions in the companies discussed herein. Past performance is not indicative of future performance. Investing involves risks, including the loss of capital. Enjoy the show. Two real fast additional points of the intro. One, this conversation was originally recorded on July 22nd, so it took a little bit of time to get out. Two, there was a short report released regarding LandBridge. I asked James for a comment. He said, I am hesitant to even comment and give the report legitimacy. Free markets with opposing views on company fundamentals are a defining feature of capitalism. However, this should not include factual errors and misrepresentations. We are very eager for LandBridge earnings release this week. The call is actually August 7th, and all listeners should refer to that call. All right, ladies and gentlemen, thrilled to be joined by James Davolos today. Did I say it right or did I mess it up the second time?
You got it. Thank you.
Sweet. Okay, good deal. Anyway, James and I were introduced by Chad Garcia, and then we recently participated in the Bob Rabat. Well, I moderated, you participated in the Markel event. So that's the background on how we know each other. And how you doing, James?
I'm doing well, thanks. I think the days of sleepy, quiet summers are in the rearview mirror now, but busy, but good busy.
Well, that happens with life, I think. Is it hot up there? It's freaking hot here.
We went through a absolute scorching June, early July. It's actually pretty reasonable in the Northeast right now, but it kind of waxes and wanes between oppressive heat, torrential thunderstorms, and then soft patches. Today, we're right in that sweet spot.
Good. Well, enjoy it while it lasts. I was going over your resume, and it appears to me, and I apologize if I'm wrong, you came out of business school and went straight to Horizon Kinetics. Is that true?
I came out of undergrad and went straight to Horizon Kinetics. It'll be 20 years in December.
Wow.
And when I was evaluating getting my MBA, they told me if I did night school and continued working that they would reimburse me, but otherwise they would not reimburse me nor hold my job. So NYU was a perfect fit for me. And then, yeah, I finished NYU about 10 years ago, and I've been at Horizon for going on 20.
Is that standard firm procedure to hire straight out of undergrad?
We don't necessarily have a traditional hiring process, but what they don't like is hiring people that have been trained in traditional banking, private equity, or even like CFA asset management channels, because they like to train people to think independently and individually. And suffice it to say, Horizon's not running CAPM models and weighted average costs of capital on DCFs that are making up nonsense assumptions to value companies. And so they like more of a blank slate. And so I would say we hire unconventionally, one of which would be direct out of undergrad.
So what do you, I guess, how has working there evolved your method of investing? Like, did you even have sort of a thought process of how to invest when you were coming out of undergrad, or is it something that you developed while you were there?
Yeah. So I grew up being pretty involved in my family's business. We had seasonal hotel motels with hot restaurants down at the Jersey Shore. Understood the power of leverage on the upside and downside from an early age, where my parents went levered long into the S&L crisis with cross-collateralized properties and personal guarantees.
God,
So
that's tough.
vaporized 99% of their net worth. And then, saw my mom basically scrape and claw and salvage the equity value in the one remaining property that they had, did a really brilliant workout, and then ultimately get out of the property at the right time. But so because of that, I always was very risk aware. I don't want to say risk averse. I was always risk aware, but also just helping her, and before that, my dad, with looking at just simple business things like, okay, if occupancy rates are 80%, this is our margin, but 60%. And the Jersey Shore, it's hot in Philadelphia. People get in the car and come down. So it's not like the modern Hiltons of the world where your RevPARs are very discernible. So anyway, that was my background. I went to undergrad and kind of just saw all the textbook ways of finance, which I think most people are indoctrinated in. And I was naive enough to think that everybody on Wall Street kind of had the answers. And so the sell side analyst at Goldman Sachs or Lehman Brothers, they knew with some degree of precision what earnings were going to be. And then they were telling the hedge fund manager, and then they knew exactly how to value the company. And so I had this naive sense that there was certainty in investing. Whereas even in credit, which is a lot more tangible and objective versus the subjectivity of equity investing, the inherent subjectivity and uncertainty of all types of investing, where the first thing I realized at Horizon within the first year was how behavioral investing is. It's not a STEM science by any stretch of the imagination. And so then that really forced me to really rip everything down and then build it back up with a different ideology and thinking of how the world and markets work.
How did the realization of how behavioral investing is, what did that do to how you think about it?
Yeah, I mean, look, I think most schools still teach the University of Chicago modern portfolio theory, efficient markets, efficient frontier. And so that needs to go in the trash can right away, because I think what you need to understand is on each side of every transaction, I mean, maybe not today with algos and AI, but let's just simplify it and say on every transaction, there's a person either directly or indirectly making a buy and a sell decision, and that person is emotional. So the Liberation Day sell-off and then the subsequent snapback and the COVID sell-off, you can't even remotely try to say that somebody was making a rational decision that incorporates all information on a extended time horizon in that snapshot. And so I think understanding that, coupled with now these exogenous forces, whether it's indexation, momentum, algorithms, quarter end kind of window dressing, I think it allows you to stay convicted in your fundamentals, but appreciate the random walk, if you will, of how markets behave.
Hmm. That makes sense. Man, I don't know. I was thinking as you were saying something, and then it totally blanked on me. Oh well, we'll move on. You guys tend to, unless I'm mistaken, and if I am, please correct me, but you tend to focus on more resilient business models. Is that an accurate description of how the firm sort of shakes out?
I'd say we've evolved that way, where we certainly were attracted to these higher quality, resilient businesses going back to the firm's founding in 1994. I think in the last decade, we've formalized that into some strategies that I run and then some that I co-manage, where it specifically almost requires that quality component of the business model. But I think at the end of the day, we try to find, okay, is there a balance sheet or an asset value that we can anchor the business to? Can we control such that we know we're going to accrue the economic returns of that asset through a higher quality business model? And then ultimately, is it valued at a valuation where we think that there's plenty of upside, and then also that kind of right tail optionality if things really go well for us?
That makes sense. Do you think that focusing on those types of businesses, does that help to reduce some of the emotional, I guess, punch that a COVID was kind of nuts, but Liberation Day does that help you kind of see through the short-term noise in certain ways because the business models are more resilient, or do you find your stocks to be just as subject to the same whims? And I guess if your stocks are subject, but you are more
Yeah.
stable, that's a positive thing, right?
Yeah, I was going to say there's kind of two different parts to that question. So in general, because these businesses have better margins, better operating leverage, less capital intensity and leverage, they do tend to have to kind of even out those big volatile episodes relative to the more leveraged, more cyclical peers. But that doesn't mean that they're immune from, I think, market misunderstandings and market manias. We could argue kind of when we get into the companies today that we're going through such instance right now. But then also knowing that you're not going to get knocked out because of leverage, knowing that you're not going to get knocked out because they're operating below break even allows you to kind of extend that time horizon and have that confidence, whereas you might not otherwise have that.
Yeah. I love listening to Bob talk about cyclicals in the area when people don't understand what earnings power can do and how much they get penalized because people can't see through those moments. Obviously some of them go bankrupt, right? So you got to watch that. But you
Yeah.
don't do the cyclical thing. I'm bringing in a separate thing that we both have heard in the past. So anyway, the idea that you had brought up at the Rabati event, I thought was interesting, and I don't want to get into the specific name right now, but I did. The reason that we wanted to do this conversation is sort of tangential to an industry that people don't like, but potentially this is, well, maybe some people don't like. But end of the day, this is an interesting niche. So do you want to talk a little bit about how you found the water solutions part of the oil and gas market?
Yeah. And I think you set the stage perfectly, where I think that the world is recognizing that we need traditional hydrocarbons, whether it's oil, gas, or natural gas liquids, which is kind of that wetter gas stream in the middle. Simply just look at the non-OECD world, so Africa, Southeast Asia, the just small marginal improvements in GDP per capita, which is basically standard of living, and that requires energy and energy intensity. And as of right now, that is not going to be solved by a lot of these renewables that were kind of forced on a lot of the world and subsidized. And so, if you accept that premise, also the energy intensity of incremental GDP growth, there's a much longer tail in growth in energy consumption, traditional energy consumption, and probably a far, far later date until you actually see peak oil, peak gas, even peak coal demand. So, with that kind of stipulation, I think that every business that's associated with these industries has a taint of some sort where there's a discount. So you could argue that the oil and gas pipelines, the oil field service companies, kind of anything that's in that ecosystem. But what catches our attention are we've historically focused pretty heavily on royalties, where you have much better unit economics and free cash flow and durations. But what catches our attention is when we think that there's secular growth with pricing and a very long runway of growth before you kind of hit your mat. And we recognize something probably close to a decade ago through our investment in a company called Texas Pacific Land Corporation, where they quietly developed a water division. So back then, the water division was just selling what's called brackish or brine water to oil and gas frackers, which they need to inject down hole to basically crack up the rocks. And so, this isn't water that is potable. You cannot be using it for agriculture, let alone drinking water. But the bigger opportunity that emerged was that so while you might have about 400,000 barrels going downhole to break up the rock of this brine water, the wells produce a tremendous amount of what's called produced water. So produced water or formation water, it has very high total dissolved solid content, so about 100 times that of fresh water. It also has a variety
What's the
of
definition of a total dissolved solid content?
Sure. So TDS would be basically the purity of drinking water is about 1,000 parts per million of total dissolved solids. And so that could be anything like trace minerals, chemicals, things like that that need to be separated out. So a freshwater drinking quality standard would be about 1,000 parts per million. This produced water gets as high as 150,000 parts per million. So in that you have hydrogen sulfide, bacteria, metals. You actually have a lot of hydrocarbons that needs to be separated and skimmed out. It's also, let's say, on average, maybe 3 to 5 times as salinic in terms of saline content as compared to ocean water.
Yep.
So suffice it to say, this needs to be remediated. So historically, it was basically just injected downhole into the saltwater disposal wells. Today, there's a lot with new technology. You can clean it up enough to then reuse for fracking. But one of the big questions facing the industry is this notion of beneficial reuse. Where can you get it to the point where it's potable? Can you use it for industrial purposes like power generation? Cooling, liquid cooling for data centers. But I skipped a big part there, which is that these wells, particularly as you go into the Delaware Basin, which is the larger portion of both production and reserves today, water cuts. So the amount of water for every barrel of oil is approaching an average of about 4 to 1. So just think about that for a minute. If the Permian's doing around 12.5 million barrels of oil equivalent a day, 4 times that is being generated in produced water, so approaching 50 million barrels a day. So you need the equivalent infrastructure to take that from the wellhead, separate out the solids, including kind of your slick and oil and things like that, remediate that waste, but then take the remaining water. You then need to either clean it for reuse. Primarily right now, you're only really seeing that for refracs, or excuse me, for fracking. And then you have something on the order of 20 to 30 million barrels a day that needs to be disposed of down these saltwater disposal wells. And so, again, going back to Texas Pacific, they have a very capital light model where third-party operators will inject and operate these wells on their surface acreage. So they'll get an easement for the transportation of the pipeline and then the injection. So that was our introduction. And I think that the more and more that the industry has evolved and some new players have come public and some other companies have been very proactive in advocating for new technologies, it's gotten more and more interesting, particularly as you might actually be running out of space, which only benefits the incumbents, in our opinion, which again is another complete misunderstanding by, I think, the broader market of generalists.
When you say running out of space, you are talking about, say, space to store the water, or are you talking about places to drill, or a little bit of both?
Sorry, so this is specifically to water that's being disposed of. And so,
Okay.
again, you take this water, and then historically, what you would do is you would inject it in these disposal wells that are below the shale. So if you think of shale as kind of this layer cake of rock that has different densities of oil and porosity of the rock in these shales, historically they'd go below it because you didn't want to interfere. So if you go above it, you might have to drill through this water section, which actually is becoming an issue today because you put water down hole, it's gravity, it spreads out. So if somebody's a mile away, your water seeps over there, they're drilling a hole, they have to go through your water.
Hmm.
Deep was the standard. However, it created seismic events. So there were earthquakes as high as a 5.0, I think even slightly higher. Luckily, very few people live in the Permian Basin, particularly as you head further west. Midland and Odessa, though, are fairly reasonably sized populations, and so those need to be considered. But so injection has then shifted to shallow. So today, about 75% of injection is shallow versus 25% deep. And the seismicity has gone down radically due to a lot of regulations, both in New Mexico and Texas. But so there's really two ways to look at it. What is your permitted capacity versus how much can you practically inject based on your pressure?
Hmm.
So pressure is a function of the space, but also the porosity. So think about if you pour a bottle of water into sand at the beach, it's going to absorb. But if you take a swimming pool and dump that onto the beach, obviously it can't absorb all that water, and you're going to have kind of a big, like, muddy mess with probably knee-deep water, depending on where you're at. The Permian's running into issues around pressure related to porosity. So you overpressurize, it pushes this water, particularly in shallow regions, into other oil-bearing areas. There's actually a lawsuit that actually was in the headlines yesterday, which is, I think, causing a lot of market contempt today. But then also, you can interfere with these old capped and abandoned wells that are creating subsurface disturbances. And so, what you're seeing is the existing pore space, both in terms of permitted, but also on a pressure adjusted basis, is running out. So now you need dynamic water management companies to get that water away from where the oil and gas is being drilled today, so you avoid that interference and then avoid the overpressurization.
Hmm. Hmm. And you had mentioned that the one of the incentives to outsource this part of the value chain is the oil companies don't really care to keep it on balance sheet and operationally don't really care to run it, right?
Exactly. I mean, historically, this was kind of run through the marketing department that handles midstream, but now it's gotten so important that, I mean, think about it. Let's say you have a 4-to-1 oil cut in some places. I mean, it's as high as 12-to-1 in some areas. If you're paying $1 a barrel to get rid of that water, that's 4, 5, $6 of your lease operating expense. With $60 oil, that could be make or break on your economic break evens. And so even the majors, your Conocos, your Chevrons, they're saying, if you can guarantee me that you can get this away, get it injected, and I'm never going to have to worry about shutting in or curtailing production, then I will pay you a premium to handle that. They're also not in the business of dealing with seismicity and ranchers. I mean, in West Texas, it's pretty difficult. There's no, oh, this is huge. So if you want to drill an oil and gas well, the mineral estate, so your right to extract these minerals, oil and gas, that takes precedent over the surface estate. So you can't say, no, you can't drill here because I have my cows running around, blah, blah, blah.
Huh.
You also can't prevent them from removing the oil and gas from the site. I mean, you can charge them, but they can ultimately have eminent domain because of that mineral estate. Water does not have any protections under eminent domain. So a rancher or a landowner can literally say, no, you're not moving any water across my land, or you can pay me a ransom. So the teams at these majors and even kind of going all the way to the juniors, it's very difficult to navigate, in some cases, 20, 30, 50, 100 miles of disparate landowners to move all this water and then ultimately get it into an injection site. And so this is a big misunderstanding where it's actually now at the benefit of all of these companies to move this to water specialists versus handling it in-house.
Interesting. Why is water exempt? I mean, I understand why oil is. That's kind of cultural, right?
Yeah.
But water being exempt is kind of interesting.
It just goes back to kind of the way the laws were written, where the
Huh.
mineral estate takes precedent over the surface estate, and you can't prevent somebody from exploiting their minerals. But within that, there's no protection for a waste product that's related to that water.
Yeah. Yeah, and I guess water isn't necessarily a mineral, right? But maybe, I don't know. Now I'm talking about things I don't know. Interesting. It would be, yeah, it's subsurface rights is what we're talking
Yeah.
about. Huh.
I mean, there's a lot of litigation. There's litigation right now where who owns the slick oil that I mentioned before that comes up as part of that produced oil. There was a recent ruling which says that the holder owns that, but then it's like, okay, well then you can get lithium out of it, and so who owns the lithium, and then who has the environmental liability? So, but as of right now, you cannot compel a landowner to provide you with an easement across their land or disposal related to water the way that you can for oil and gas.
Interesting. Huh. And when I look at one of the companies in this space is Eris, when I look at their corporate presentation and whatnot, it looks like they almost have big ponds built. Is that accurate, or am I not seeing things correctly?
Yeah, so a frac pond could be two things. One, it could be kind of an area where you have this fresh water or this recycled water that's waiting for the drilling pad or the multi-frac to basically take that water and inject it down hole. But then also when you have this huge water cut, you separate out your oil and gas, and then you have this sludge or slurry, which has that really high total dissolved solid content in the pond. You then separate the solids and remove the salt water, and then that salt water is what's transported and disposed of. So it's one of multiple stages of the infrastructure as having these pools, both for output and then also for inputs.
And then when they're disposing the water, I know you had said earlier you're disposing it, or some of the disposal is into the ground. Does all of the disposal ultimately end up in the ground, except for what's reused for fracking? Or, like, I guess what I'm really getting at is when you look at the PP&E, you've got like pipelines, and then you've got, I assume, some of these pools. There's a small amount of office, but like it does seem like these assets are sort of long lived
Yep.
and don't require much maintenance capex. Is that a fair read, or is that a misunderstanding?
Yeah, I mean, so virtually everything that comes out is disposed of, and the fact of the matter is, there's so much. If these new wells need 400,000 barrels to frack, but then the basin is generating tens of millions of barrels of produced water a day, even if you are using 100% recycled water, you still have a plug where you need to dispose of or find a beneficial reuse treatment for tens of millions of barrels of water a day. And so, yes, the primary assets of these companies, as you mentioned, would be the pipelines, the easements or the right of way, but then also the saltwater disposal wells, which are actually pretty technically complex, where they have to be cased in cement and steel again to really prevent against that of the
Earthquakes and
leakage
whatnot.
and that exactly. And so, but there is a lot of scale to these networks, particularly when you already have the pipelines, when you already have the treatment facilities to bolt onto that versus building it new and dealing with new landowners and easements and all of that.
So the geographic area that both makes economic sense to dispose of these things, or all this water, and like the other thing that I'm thinking is, if I'm, I don't know, Oklahoma or whatever, I don't necessarily want Texas water to be disposed of in Oklahoma. They can kind of deal with their own stuff. I'll deal with my own stuff. It sort of feels to me like there's a geographic advantage to the location that you're in. And to your point, you said earlier, running out of space a little bit, I think, unless I'm putting
Yep.
words in your mouth. So there, I don't know that there's a moat in the Morningstar definition necessarily, but like excess returns. But certainly geographically, it seems like you've got to be well located in order to compete. Is that a fair read?
Absolutely. And one of the biggest businesses right now is getting a lot of people don't realize that almost half of the Delaware Basin production is in New Mexico. And New Mexico has far more stringent regulations around every type of disposal well. They've actually recently banned shallow. So a lot of that water gets transported into Texas. And so if you have disposal systems and an infrastructure to get it over the border, you can command massive premiums to in-state networks. And so right now it's been a huge boon to Texas and Texas water systems. And some people have been worried about, well, if there's a regulatory development in New Mexico, what happens? And I think that's more vulnerable to New Mexico disposal systems, because I don't think they're going to get any more lenient. So I think there's more and more of a priority to make sure that you have egress to get that into Texas if you need to.
And why is that? That's just politically, New Mexico's not leaning anymore.
Yeah, I mean, New Mexico is oil and gas is absolutely massive to funding their state and a lot of their social programs, but the state has skewed Democratic and they have a very pro-environmental stance. And so differing intelligent people have differing views on if they're overly or appropriately stringent. Texas, you have the Railroad Commission, which oversees most of this in terms of permitting the injection, the pressure. Now there's actually these different, seismic reporting zones and different operator response protocols. But in Texas, it's a much more lenient. Obviously, it's a Republican administration. The RRC's had some shakeups in who runs that organization. But, you know, long-winded way of saying yes, it's largely based on the politics and the objectives of the state regulatory authorities.
Okay. That makes sense. When I was looking through the 10K, it seems like, at least of Eris, it seems like what is it, Conoco and Chevron are two major customers. I believe Conoco is not growing. Chevron is a little bit. I could be wrong on that. Do your own due diligence. But do you worry at all that over time the majors get more bargaining power, or do you think that over time the bargaining power stays where it is or maybe shifts in favor of the water companies?
Yeah, I think that again, you rewind to when Eris first came public. They acquired an asset, and so they kind of inherited this big Conoco concentration. And a lot of that back then, you did have a lot of I think that was actually Concho, was originally Concho, which was
Oh,
acquired by Conoco. But again, this goes back to a day when the operators really wanted to handle this all in-house. And so now that you're seeing more and more of an impulse to get this out of the off the balance sheet and not operated directly, I think you're getting more and more leverage at the water company. And I do think, if anything, you're going to have the bigger players squeeze out the smaller and marginal players, where we've even heard people talking about a large operator paying for the right to use injection space 5 years out, because they say, look, we're going to get to this pad, we're going to drill it. It's probably in our 28 to 2030 drilling program. We want to make sure we have no issues and we want to have this locked in. Can we pay you to hold this in your system for us? And then you'll be there in 5 years. And so all of this to me says the incumbent land and water companies are going to have more and more leverage, and probably the people getting squeezed would be the smaller players that can't commit the budget or the balance sheet to it on a going forward basis.
who are, just to set the stage, who are the incumbent players?
So the biggest one today, well, the biggest sponsor is 5 Point Energy, which is a private equity firm out of Houston run by David Capobianco. His crown jewel of the system, or at least of the midstream, would be Waterbridge, which there's no S1 filed yet, but there's suggestions that they're going to go public in the fall. That's the Delaware Basin system. They also have a big Midland Basin system that's separate from Waterbridge for the current timing. But if you were to combine those assets along with Landbridge, which is basically the ranch assets, almost like a triple net lease underneath the water systems and possibly data centers and power generation systems, 5 Point is the biggest player that in the industry by quite a large magnitude. Then you have Eris, which came out of Solaris, another sponsored company where they're mostly New Mexico, Delaware Basin. They've recently branched out in developing a ranch up in the Panhandle to basically get these barrels out of New Mexico, pretty far distance east. But they also have a pretty big water solutions business where they're pretty forward in thinking about recycling, beneficial reuse. Where else could this be used? Lithium extraction, things like that. You also have Texas Pacific. So, as part of an overall land and mineral company, you have Texas Pacific Water. They're generally more of a passive player where they will permit injection wells on their site, although they're actually doing a lot of really interesting things around piloting beneficial reuse, desalination, and water. And then there's Select Water, which is also public, although they have a lot of different assets in a lot of different jurisdictions. They're actually getting into municipal water contracts. And then there's a variety of private players. So that's kind of, and then also kind of the biggest volumes by far today are in-house. So they're dealt with existing midstream companies that where it's a small part of their business, like NGL Partners, Western Midstream, but then also in-house at the Chevron, Exxon, Conocos of the world. But for all intents and purposes, when you're looking at the public market, Eris is really the only pure play that's public. We'll see if Waterbridge comes public, and then TPL has their water business and Select has their different water businesses as well.
What's going on with, like, I just pulled up Eris's stock. It looks like, I mean, it had a good run, so obviously things can consolidate, but looks like it ran up through March and then kind of sold off. What's the narrative around what's going on today, or the reason for the current confusion?
Yes, I think it started with, Eris beat on volumes and margins and prices when they announced their first quarter earnings, but the stock traded off, I want to say 18 or 20% on everything that I thought was in line or above estimates. And I think the commentary on the call was very defensive around like, look, this, or remember, this is still in the wake of Liberation Day. And they're saying, look, we think based on what we're seeing right now, we're really confident in the first half of the year. And I think they maybe made some comments kind of downplaying the potential for M&A. But I think more broadly, and particularly more recently, the market's gotten concerned that, okay, $60 oil is really tough for shale. Does the Permian flatline? Does the Permian roll over? And I think it's missing a couple big variables. First and foremost, because of the nature of water. So as the wells age, you don't really see the amount of water go down. The oil goes down, but so basically the output of water stays the same, even though oil goes down. So these Permian wells, while you have all of this front-loaded oil and gas in terms of decline rates, it's basically a 30-year contracted water stream. So as long as production is flat, you have a very stable, actually even growing water stream. The other interesting aspect is that so now that you've really hammered a lot of the tier one shale locations, as you go deeper, it's more pressure and more water. So as they start drilling tier two, tier three, tier four locations, which has already started, the water cuts are just going to go higher. So again, you have this organic growth by the aging of wells and then drilling secondary formations, which is increasing an already high base that the market doesn't really appreciate as not cyclical with oil and gas completion activity. So I think that is a big misunderstanding on the first leg of things. I think more recently there was a lawsuit with State Line Operating LC, basically arguing that Eris and Devon, through one of their shallow disposal wells, flooded some of their hydrocarbon bearing rock. And it's a PE sponsored company where they kind of carved out some assets and then left this as a shell to basically litigate these residual claims. So the defendants are arguing statute of limitations around 2 years, but at the end of the day, I think it just adds more uncertainty. But again, I think it's a missing the forest for the trees here, because at the end of the day, if the United States is the largest oil producer in the world, if you look at barrel of oil equivalent, oil, gas, NGLs. And the Permian Basin is, call it 50% of that. If we are going to continue, meaning we, the United States, are going to continue to balance oil markets based on our shale production, water, by definition, has to be a huge part of that, with both volume and pricing, I think, accruing to these water companies. So,
And to reiterate the reason why, just for the sake of, just bringing it back. One, you need the water in order to frack shale properly. And two, I don't know if you said it before, but it's taking more water to get a gallon of oil out of the ground as the quality of the well degrades. Is that correct or no?
yeah, so two different, as the well gets older, the water cut increases, but also as you drill different parts of the shale, those have higher water cuts. So yes, those are both, but the Permian cannot produce 12.5 million barrels of oil a day without disposing of, call it 30 to 40 million barrels, or at least handling 30 to 40 million barrels of water a day. So if the US is going to continue to basically balance global oil markets, you need that water to be figured out. And
maybe more, right?
Yes, exactly.
Okay.
So that's what I think it doesn't really understand, is that, okay, even if, let's say on the left-hand tail, shale is plateauing, you still have organic growth because of this water cut dynamic and because of volume shifting to the Permian. You also have pricing. The whole ecosystem is growing even with flat production. But to the extent that the US is going to have this energy independence and balance global oil markets and appease the administration, it's actually going to keep growing. And then once it starts flowing, because of these dynamics, you have decades of contracted cash flows, which is very distinct from oil field service companies and then traditional gathering and processing pipeline companies.
But those contracted cash flows, that's not really what you're playing for on the equity side, is it?
No, I mean, we
I
think
mean, it's
that
the underlying, it's the fundamental layer that is the beginning, right? But
exactly.
the growth is where the economics could accrue to the value or to
Yeah, we see volume growth, we see margin growth, and then critically, that's enough in and of itself. I think we can talk about comps a little bit later and something interesting there, but I think that in and of itself makes it an extremely compelling investment opportunity at the multiples today. But at Horizon, we love optionality. And so is there a call option in the business that is priced at a zero or negative value? And so we talked about beneficial reuse earlier. And so I think the first iteration of beneficial reuse will be to desalinate. You can't do reverse osmosis. Again, the salinity here is just far too high. So people are looking at different freezing and heating technologies. But so first iteration of beneficial reuse, could it be used to replenish these rivers and agricultural reasons? To the extent that that's feasible, I'd imagine that there's some pretty big government grants if you're basically replenishing radically drought-ridden part of the country. Let's say the technology takes it a step further. Can it then be used for industrial purposes like combined cycle gas technologies? So if we're going to build 5, 10, 20, 30 gigawatts of power generation to power AI, which it seems as though the entire world is in agreement we are, it's a question of how quickly we can do it. Gas is the solution. And I won't get into the nuances, but you can't have intermittent wind and solar. Grid scale batteries are just prohibitive. The technology doesn't exist. And go look up the last time the US tried to build a nuclear facility bigger than a gigawatt and look at how long and how expensive that was. SMRs, great. Add 10 megawatts, 50 megawatts in 10 years. Like, what have you done for me lately? No thanks. The solution is gas turbines. That's why GE Vernova and the Siemens and all of these companies have 3, 5, 7 year backlogs, but combined cycle gas technology is steam. And yes, you can capture some of that steam and reuse it, but a lot of that also is evaporated. So, the incremental price that they could pay for water, for industrial water, for CGGT is massive compared to the ability and the elasticity of an oil and gas driller, particularly at $60 oil. Then the other call option, which is probably admittedly further down the road and less visible and likely, is these data centers that are running these GPUs. If you're doing it in the middle of the Texas desert, these things are hot and you're going to need liquid circulation for your cooling. And you would need a step function change to get this water pure enough. But again, the optionality around those different stages of beneficial reuse, that just isn't priced into these companies trading at 8 times pro forma. So volume, price, margin, multiples probably too
pro
low.
forma
Even if it's
EBITDA, right?
correct.
Yes. Okay. Just want to make sure.
You're buying, some of these things where I think just the market just isn't cash flow alone. If the multiple doesn't re-rate and you just get the cash flow, you're doing fine. Multiple re-rates, you're doing great.
And when you say the cash flow, I mean, just to like, because look, I think if you pull it up and you don't know what the pitch is and you haven't done the work, and for the record, I don't own this, so I'm not talking my book, but I find it to be an interesting idea. I mean, you're looking at the trailing multiples, 25, and you're in oil and gas, right? So I think that may, in a weird way, keep people out to the point that if the stock outperforms in the future, it could be because people can't open their mind and see that it's actually cheap when it may appear optically expensive if you're not thinking about it the right way. Does that make sense?
Yeah, and look, there's a lot of DD&A here, and then right now these systems are being built out, so there's also some CapEx. And so not only are your GAAP numbers pretty messy, but then certainly your free cash flow conversion is messy. But I think you have to look at it on what do you think the addressable market is, what are their capture rates. You've seen pricing go up, you've seen margin go up, you've seen utilization go up. And so you look out, let's say T+3 at these numbers, and it's just radically inexpensive once you're willing to kind of make those adjustments and look at what kind of the run rate business will be versus the business during build out mode.
Makes sense. Makes sense.
Now,
I appreciate you saying that, because I think when I think that's an insightful comment, and I think that hopefully illustrates to the listeners how you think, because when we've talked just a couple times in the past, but you do tend to be like a T+3, T+5 guy in my head, at least. I perceive you to be somebody that's thinking long, and not saying you're thinking long, you're actually doing it, which...
Yep.
You know.
Well, the name Horizon Asset Management stems from when they started the firm. They said our only advantage is to extend our time horizon. So everything we do is a 3 to 5 year minimum underwrite. And ideally, if we do our work right and the market kind of doesn't run ahead of ourselves, we can own stocks for decades. You brought up something else that I wanted to just bookmark before I forget. But so again, you have these secular drivers that should drive volume, price, capture rate. That should flow through to margin. But then also you have decades of these contracted take or pay agreements. Also, you have very high competitive barriers to entry because you can't go out there and replicate one of these networks. You're running out of pore space. There's a lot of expertise here. So everything about these businesses is high recurring revenue, CPI escalator, price, margin, and then also this optionality. These aren't really, that doesn't sound like an oil and gas adjacent business to me. The closest thing that I could think of would be waste. So you think of industrial waste, something like Clean Harbors, or then these residential waste companies. And I have to actually acknowledge our mutual colleague, Chad Garcia at Schwartz, because he's followed waste for years. And he said, these are almost like better waste companies because, the GFLs and these companies of the world, Casella here in the US, that are trading at, anywhere from 16, 18, 22 times EBITDA, you need labor, you need trucks, then you're ultimately taking it to a landfill. Like, they're not exactly the cleanest or greatest businesses, but it's recurring and it's inflation indexed, and people have this ability to say, look, I get it. Like, I'm not going to go take my trash to the dump. I'll pay somebody a CPI escalator. And anyway, it's a better business because once you build these systems, you basically just press a button and these things are operational. Like, sure, to grow, you might have to add a pipeline, but the incremental returns on invested capital are off the charts.
Well, that's what I was trying to get to, and it feels like your terminal economics. I mean, obviously, eventually these things will forget about these things. That's too vague. Eventually, the cement in something that's capturing wastewater will need to be redone, I guess, eventually, right? But like, it does feel to me like this is a scenario where your depreciation is going to generate a true cash benefit as opposed to something that requires cash offset.
Yeah, just like real estate. I mean, eventually the rebar underneath a premier tower on 57th Street in Manhattan is going to have to be redone, but it's probably good for the 30-year depreciation schedule. And that's
right. Yeah. Yeah, that's right. That's better said.
But just going back to that is, again, these things, let's say, the gathering and processing pipelines are maybe 9, 10x businesses. This is all EBITDA. The waste companies are 16 to 22 times businesses. And so, if you can buy these businesses at a 20, 30, even 40% discount to the gathering and processing, but then they're actually more like the waste. I mean, if the market just recognizes these businesses for what they are, you could have just a radical re-rating in these companies and just get paid to wait because of people. It's such a niche business. I mean, most people don't realize how water intensive the oil and gas business is, let alone do the work to understand the recurring nature and then the pricing power of these businesses.
And the scenario that you get sort of waxed, for lack of a better term, is America sort of bails on gas and oil production because oil sits at 45 to 50 and the basin is not economic. Like,
Yeah, I mean,
is that the risk here?
I'd say the bear case is that there's some sort of a global depression where oil demand is, whacked and you just don't have, and then OPEC decides to keep market share. And again, you are sub 55 below the marginal cost of production. Um, One of the offsets to that is if you believe in AI, the amount of incremental gas we need. So you're going to have a lot of political incentives to keep these wells running because you need that gas to basically keep the US power grid going with all of the reliance on gas. But that's where it does get tricky is, or does the basin reach these levels where there's not as much inventory as people thought? I think the geology is pretty well thought out, and if anything, technology increases EUR, so estimated ultimate recoverable oil in place. So I do think that the multiples are a function of the view: A, shale's going to roll over; B, shale's uneconomic; and then C, energy is a sunset industry. How could I ever capitalize these at a reasonable multiple?
Yeah. Yeah. I mean, I guess I understand it. Feels like some of that could be mitigated through position sizing.
Yeah, and I mean, look, I think the world of the management team at Landbridge at Five Point, and so to the extent that they do a road show and look to get Waterbridge public this fall, I think that they're going to do a really good job explaining the nuance of the business and the differentiation of the business. And so their ability to successfully execute on that, I think, could be a big catalyst for the industry. Also, as you start seeing second quarter earnings coming in a couple of weeks, if they show resilience and they kind of, more importantly, I think their guidance for saying, look, like, we're very confident in our volumes through the end of the year. Like, this is not a cyclical business. Again, I think there's a lot of potential catalyst to reset the narrative in the next 6 to 12 months.
Is the reason, well, I shouldn't say the reason, is it a contributing factor to why the water companies seem to be private equity backed on average? Is that a function of the public markets disdain, for lack of a better term, for oil and gas investments over the, let's call it 2016 to 2021 time period? Did it just kind of open up an opportunity for private capital to go out and capture share, or did it happen for a different reason?
I think it was small. And so it took entrepreneurs. In the case of Waterbridge, David Copabianco and his team with Jason and Scott, and then at Eris, Bill Zartler and the Solaris team, where these are boots on the ground people that are in Texas and they saw an opportunity. But if you're Enterprise or Kinder Morgan or the natural midstream players who should have identified this, they're just like, the biggest players are maybe going to be doing like 300 to $500 million of EBITDA, in a couple of years. And they're just like, I'm not going to bend over and pick up a quarter. So I think it was the entrepreneurial nature to go after a nascent business where the bigger incumbents said, I'm not even going to bother. And I think the bigger incumbents just said, look, I don't even like, maybe if somebody calls me up and says, can you help me out here? But now I think it's almost that, okay, now there's a specialized group of providers instead of your juggernauts that are in the MLP space. But I think the secondary element to that is also kind of private capital was more aligned to build and wait versus, okay, I need cash flow day one to get an equity multiple. And so I can do my, secondaries and then do, public debt. So a lot of reasons, but yes.
How long did you follow TPL before you saw the water division or the water business sort of start to make a difference?
So
Or
Murray,
or
our
what
yeah.
like gave you the, how, I guess what I'm at, yeah, go ahead. Answer that and we'll see.
So Murray Stahl, our CIO and chairman, he's owned TPL professionally since the mid 90s, and I think personally even earlier. It was a boring ranch grazing land company that kind of did nothing. And then ultimately, right place, right time, the shale revolution came to them where they just so happened to have just the analogy I like is the Times Square of real estate in the middle of the Permian Basin, right along state line. And Murray was talking about water. Uh, Being a big business well over a decade ago. This
Huh.
is way before he joined the board, way before TPL converted into a C Corp. And originally, that was just that, again, that source water. But then we started recognizing the water cuts are growing. This is becoming a really big deal. But I think we realized what a massive business this was going to really be probably 3 or 4 years ago. And I think it's actually outperformed industry wide based on even kind of where what we were seeing back then.
And then, due to Murray's involvement and your involvement, I mean, how open is your line of communication to other investors within the space like Five Point? What I'm really getting at is your process seems to involve talking to a lot of different players and really understanding what's going on. Is that an accurate description of what you guys do at Horizon?
It is. And so we're not your firm who's going to be calling up management every quarter saying, like, hey, walk me through the quarter. Like, honestly, I don't care. We more will talk to them when we see something that is a fundamental development in the industry and want to talk about it. So, hey, what's going on with seismicity? Oh my gosh, I see this new Rule 8 with the Railroad Commission and these different injection standards. Or is beneficial reuse a real thing? And then you talk to kind of all the incumbents in the public, you talk to some of the privates, sell side a little bit, some industry people. But yeah, it's really triangulating that because especially with this water and this porosity and pore space, and you talk to 12 people and you're going to get 16 different opinions right now.
Huh.
So yes, it's very important. And I think being plugged in and kind of having that proprietary information flow is really important to stay ahead of these things.
Yeah. I've read super old write-ups from Murray on TPL back when I think it traded at under 10 times cash flow and it was just a share cannibal and
Yeah,
you
exactly.
know and it was so it was interesting when you brought up the water solutions part because one of the things I had said to you is I said I perceive you guys to be sort of looking for capital light and this is in a capital investment period. So it just kind of it was interesting to hear you talk about it. So thank you for
Yeah.
sharing it. I mean, do you have a sense of, let's say Waterbridge comes public. I mean, is there a true geographic advantage to one of these vis-a-vis the other, or are they all reasonably relatively competitively equal?
I think Waterbridge has something really special because the team at Five Point recognized one of the biggest impediments to building out this gigantic dominant water system is land. Remember the comments about eminent domain. So they bought a fulcrum asset in the form of the Hanging H Ranch right after COVID, which got them about 70,000 surface acres. Then, right before going public, they bought the DK Boyd Ranch, the Speed Ranch. But so they own close to 300,000 surface acres today via Landbridge. And the core business of Landbridge is basically a triple net lease to Waterbridge. And so Waterbridge can do more than any other water company because they basically have a land bank company that is their sponsor and management and co-managed. That's an enormous competitive advantage for Waterbridge. And it allows them to do things like I mentioned before. If somebody wants to contract reserve space 3 years hence, or an operator is about to embark on a big drilling plan in a previously undeveloped shale zone, they can work with them to make sure that they have a turnkey solution years away and you're not dealing with 12 ranchers and you've already got things permitted, et cetera. The other interesting nuance of Landbridge is, again, you've got a company called PowerBridge within Five Point, which is developing infrastructure to facilitate data center developments. And so you can't have data centers without power and infrastructure. And I think that because of that, there's a very high likelihood that there's going to be a symbiotic relationship with any beneficial reuse. initiatives around, again, getting that industrial water, getting municipal water, replenishing kind of the Pecos watershed, et cetera. And so then I think the final piece would be full, probably, I'm not sure exactly the timing on this, but there's probably almost an equal sized business sitting in the Midland Basin, which when they're ready, I think there's some different M&A that needs to finally close. They could bolt that on and then really be the juggernaut of the water midstream space. So I think there's a lot of really interesting nuance to their business that can really position them as a leader, which is going to, like, rising tide should lift all ships here.
Yeah. Is it possible that you get an Aris Landbridge sort of merger, or do we run into some sort of antitrust issues on that?
A lot of people have speculated Waterbridge Eris.
Yeah, okay. That's what I meant. Yeah.
You would think that it would make sense operationally. I couldn't imagine. I mean, this would be a fraction of the market share of like an enterprise products, a Williams or a Kinder Morgan. So
Yeah. All
I don't
depends how you define the market, right?
exactly. I don't think you would get
Yeah.
antitrust. I think it's more, I do think the Solaris team understands that their assets are cheap, and I don't think that they're willing to part with them cheap. But, one of the things with private equity sponsors is they don't have in the infinite horizon that other people have. And so, look, there should be consolidation one day, but I've said this about the royalty space, and you're finally seeing some of the gold companies realize, like, I'm not going to fight this fight forever. Where Sandstorm finally agreed to get bought out, and some of the other players like Mavericks and anyway, it does make sense. I don't necessarily think it's all that likely to happen between now and the fall.
Yeah. The other thing that I'd be remiss if we didn't touch on, there is a dual share class, right? Seems to me that over time there will be one share class. Is that how you see it also, and how do you think about that? And
Yeah.
potentially having a private equity overhang to the stock as they sell down.
Yeah, again, with the sponsors, I think they need a certain amount of control, especially because they need to sell down their interest over time. And so the dual share structure kind of allows them to still kind of control their sell down, but I think ultimately that will be consolidated over time. And I think most of these firms have really good governance committees and anti-conflict committees. But you brought up a good point where it's like little nuances like that can prevent broader adoption and ownership. Like Viper. So Viper is a oil and gas royalty company. Great company, phenomenal assets, phenomenal management. They've been the consolidator of minerals in the Permian and broader lower 48. So when they came public in 2014, this was before the original Trump tax cut. So everybody was a limited partnership because you could basically pass through all of that cash flow just like you could a REIT as an LP. Tax cut, corporate tax rates drop, and call it 14-15%. Everybody converts to a C Corp. So they're a check the box taxable C Corp. However, many long onlys and indices still could not buy Viper because it was still a limited partnership in name, even though it was a taxable entity. So it wasn't until they converted into an actual C Corp that indexes and a lot of long only accounts could actually own the stock. And so again, clearing up dual class structures. And then, if these things get categorized as waste versus oil field services, like the tail wags the dog with some of these things, just increasing liquidity. And I think that, the management teams are not blind to that.
Yeah, it has been an interesting. I guess I had heard it, and it's not like a recent observation that I've had, but over time, it has been interesting to me when I talk to some people about some idea. Like, if there's an idea that is cheap, but it also has a K1,
Yep.
so many people are just like not interested at all in it, and that's kind of odd. I mean, I get it. I do get it.
Yeah.
It's administratively awful, so
I'm
it's
actually going, yeah. You brought up something where I'm actually going to eat some crow here. I was so scarred from the MLP experience where, you go back to the glory days of MLPs where these things were trading at outrageous multiples, but remember they had the general partner, which made private equity carry look like a charity, the
Yeah.
economics that these GPs were getting, to where like they just bled the LPs dry.
The IDRs, right? Wasn't that what
Yes,
they were? Yeah.
exactly.
Yeah.
But so then you had these things were trading. I mean, some of these pipelines were trading at like three caps, like 3% yields, because people just thought, you know, the implication was you're going to build pipelines to the moon. So the whole thing collapsed under its own weight. But then to make matters worse, you've got these K1s. And like I remember talking to some clients that were at MLP managers, and they had a capital loss, but they were, if they were to sell, they've already depleted their entire tax basis. Anyway, I had
Yeah.
so many scars from the oil and gas pipeline MLP era that when Eris came out, I was just like, another pipeline company. Like, I can't deal with this. So I kind of
Oh,
just
interesting.
dismissed it. And it just shows you that those cognitive biases where I kind of gave it a once over. It's like, yeah, they're spending a lot of money. It's a pipeline, capital intensive, and then kind of gave it a fresh look and then realized, wait a second, this is actually very different and a really interesting business. But again, it shows you those to catch yourselves in those kind of cognitive biases is a really interesting thing as you evolve as an investor.
Yeah. Well, good for you for relooking, right? It's very easy to just put it down and say, no, I'm good, right? So kudos on an open mind.
Thank you.
Yeah, they say the open mind is where the opportunity is. I think. I think. Anyway, thank you very much for coming on and doing the overview of kind of what's going on in this space. I think it's super interesting, and um, I hope it's a fruitful conversation for you down the road. I like when people call me back and they say, "Hey, somebody heard the conversation you did, and then they called me." So I look forward to that call from you.
Yeah, let's hope so. I think the more we can kind of tell the story, but I think it's really exciting times, and I think we're going to be hearing more and more about water in many different facets over the next couple of years.
Cool. Well, thanks again, and have a good day.
Thanks, Bill. You too.
All righty. Hang on.